Hello everyone, guys. Hi, how are you all? Good afternoon, everyone. Hello, good afternoon. How are you all? Audio, video, everything is clear, everything is working fine. Just please comment once. Just please comment once about the audio and video of the class. Is everything is working good? Is everything is working fine with all of you? Hi, guys. Hello. How are you all? Hello, everyone. So everything is good, working fine, no issues. Just please comment once. Whoever is watching this session, just please comment once about the audio and video of the class. Everything is good. So let's start this session. So today we are going to discuss and we are going to start module B. So module A is finished, right? So we are going to start module B. Okay, PPP module B. This is principle of lending, different types of borrower and type of credit facilities. This is unit 22, right? So let's start discussing this topic. First of all, the cardinal principle of lending, very important portion of this complete chapter. So the business of lending is not without any certain inherent risk. You all know that if you are lending as a banker, you will involve yourself with a lot of risk, okay? Especially when the bank depends it on largely on the borrowed fund. Now, what principle of lending means? What the things you need to understand while giving any type of loan. So if you are giving any type of loan, you are lending, right? So you have to make sure about these six things. If you are making sure about these six things, these are the cardinal principle of lending, right? So first of all, if we talk about the first thing, that is safety. You want to ensure that the funds you are lending to the borrower should be safe. You should ensure that the fund, whatever the fund you are lending, it should be safe, right? Second, it should be liquid. Second is what? It should be liquid, means your fund shouldn't be locked up for a very long period of time. It is very easily convertible into cash. Third, of course, you have to see the profitability. Of course, you have to see what? You have to see the profitability of the related things, right? Fourth, you have to see the purpose. For what purpose you are giving loan? See, you are not giving loan just because the person is asking for you, right? This is not a way of lending. You are not just giving loan for the sake that the person is asking for you. You have to give loan because there is some specific purpose, and that specific purpose should align with the bank's policy, right? Diversification of the risk. Now lenders should diversify their loan portfolios to spread risk. So banks actually do what? So they set margin for each and every sectors, okay? For lending, for example, they said that okay, we have to lend in each sector this amount of money, okay? Why? Because see, if any one sector goes in recession and they are not profitable from these sector, the rest sector will give them the money, right? So to diversify their risk, to spread their risk, the lender should have to diversify their loan portfolios, right? Now, the securities, if we talk about the securities, yes, there are seven C's to judge the securities of the credit. And what are these seven C's? Character, capacity, capital, collateral, condition, cash flow, and credit worthiness. So these are the seven C's, okay? Seven C's for judging the security. There is a diversification of risk, there should be a purpose, there should be a profitability, there should be liquidity, and there should be safety, right? Now there are different type of borrowers a bank is dealing with. So bank are dealing with a lot of borrower, if we are talking about. So what are these different type of individuals to which the bank is dealing? What are these different type of borrowers to which the bank is dealing? First, the minors. So those who are under 18, they cannot form a valid contract, right? So what agreement made with the minors, they are actually wired from the very first step, right? So if there is any assets that are pledged for minors loan, these are not recoverable except it is for necessity. So if there is a loan that is given especially for the necessities, for meeting necessities of the buyer or of the minor, then their personal estate is liable for the recovery of that loan, else it is not liable, okay? So Section 68 allows that a minor's property is liable for such type of loss. Clear? Now, unsound person. So, if we talk about the unsound person, yes, individual who are not of sound mind can't enter into a valid contract. They cannot enter into a valid contract. Okay. Next, disqualified person. If you are a statutorily disqualified individual, you cannot enforce into any contract which is made under Section 11 of Indian Contract Act. Right. Married women. Married women are allowed to independently obtain loan from the banks, and their husbands are not responsible for their. If there is a Pardhanasheen woman, yes, despite of different obligations and strictness, a Pardhanasheen woman is all allowed to have a loan. Yes, but there are extra verification that is done in this case. If there is an illiterate person can use their thumb impression for having the loan, right? Reading and explaining document in front of the witness is very crucial, right? Next, if we talk about the different type of borrower, so these are the individual. Then we have a proprietorship firm. Now, if we talk about the proprietorship firm is the firm which is owned and handled by the single individual. So these are those firms which are handled and owned by the single individual. Then these are known as proprietorship firm. Sole proprietors have an unlimited liability. Means if there is any default on loan, their personal asset is also liable for the recovery of such. Right now, partnerships. Yes, partnerships are regulated under the Partnership Act of 1932. So there is a Partnership Act of 1932 under which the Partnership Act is regulated, right? Now, if we talk about the partnership registration is actually not mandatory. It is not obligatory, but yes, if you do, then it is very good, right? So verification is essential. It is not obligatory. Verification is essential, but it is not obligatory. So if we talk about the essential ingredients of the partnership firm, first of all, it is an association of individual. It is not a firms. It is an association of individual. It is not association of firms, right? Two existing partnership, they cannot merge into a one thing. They cannot merge. Okay, so if for example there is ABC limited partnership, there is XYZ partnership, these have three partners, these have four partners, right? Now if we talk about these two partnership, can these two partnership form another partnership? No, but yes, the member of any of these partnership can form a different partnership, that is allowed, but these two partnership can't merge and form a new partnership. Okay, and the limit for the partners in a partnership firm, if it is a profit-based partnership, it is maximum 50 partners, right? Now, if we talk about the Hindu undivided family, now what is a Hindu undivided family? Okay, so Hindu undivided family is actually automatically formed when Hindu, Sikh, Jain, or Buddhist families come together. It includes all the person lineally descended from a common ancestor and their wives and unmarried daughters. Okay, but now this is the ruling of Delhi High Court that married daughters are also can also be the co-partners in the Hindu undivided family. Right now, the member family is known as the co-partner, whereas the eldest male child is also is known as the karta or the manager. If we talk about the liability of the co-partner, it is limited to the extent of share they have in that property, whereas the karta, the manager's liability is unlimited, right? So if the account is open in the name of Hindu undivided family, all the adult member has to sign that account even though the karta can only operate the account, right? So co-partners liable, it is only to the extent of share they have in the family property and there is no personal liability. Clear? Next, now there is a limited liability partnership. Everyone whoever is watching this session, guys, it's a request that please like and share the video to the maximum you can. If not, you are not liking and share the video, then we educators are generally not motivated. Everyone, this is the new channel which is started for all of you, okay? And this is especially for those students who are in English medium. So kindly just please support and like and share the video to the maximum you can, right? Everyone, okay, done. So next, there is a limited liability partnership. Now, what is a limited liability partnership? A limited liability partnership is formed under the Limited Liability Partner Act 2008, which have a perpetual succession. Perpetual succession means the changes in the member does not affect the existence of a limited liability partnership. The changes in any of the partners, the changes in any of these partners cannot affect the perpetual succession of a limited liability partnership. Now, a limited liability partnership should have at least two partners, and they have at least two designated partners, and one should be a resident of India. Okay. Now, who cannot be a individual partner in a partnership, limited liability partnership, if he or she has unsound mind, discharge, insolvent, pending insolvency, etc. Right now, under this limited liability partnership, there's a concept of small limited liability partnership. Now, what are the small limited liability partnership? A small limited liability partnership are those partnership in which the contribution of each partner doesn't exceed 25 lakh overall. Means if you have how many partners, no matter, but the contribution of the partners doesn't exceed 25 lakh. And if we talk about the turnover for the immediate preceding financial year does not exceed 40 lakhs. So if it is within these numbers, then it is considered as a small limited liability partnership, right? Now there is a company. Now the company, what is a company? First of all, if we talk about the companies, voluntary association formed for profit. First of all, it is a voluntary association for profit. It is a perpetual existence. Means if there is a changes in the number, it cannot affect the existence of the company. Okay, shareholders' liability is generally limited to the amount unpaid on their shares. Okay, now if we talk about the company, company is considered as a legal person which is distinct from members and shareholder. Now there are different type of company. Again, important thing, first of all, private company in which the transfer of shares is actually restricted. So there is a restricted transfer of share. Now it has a limited number of members, which is 200. Maximum number can be only 200. Minimum is 2 or more. Whereas there is a public limited company. Now, what is a public limited company? Where the shares are freely transferable. There is no limit on the transfer of share. Okay. No restriction on the numbers of member. Okay. Then it is formed by 7 or more person. Okay. So minimum is 7, maximum no. Minimum is 2, maximum is 200, right? Now, one person company is a company which is actually run by only one person as a member. And one person company may lose its status if the paid up capital exceed 50 lakh or the average annual turnover in the three preceding financial year. In the three consecutive preceding financial year, if the annual turnover exceed 2 crore, then it loses the status of one-person company. Now, there is a concept of a small company. What is a small company? So small companies are those companies, first of all, it is other than a public company, and it should have a paid up capital which shouldn't exceed 50 lakh, and it should a turnover that shouldn't exceed 2 crore. So if the turnover is not exceeding 2 crore and paid up share capital not exceeding 50 lakhs, then it is a small. Now, government company, any company in which the central government or state government or partly both, okay, less than 51% a share. Sorry, not less than. Means if there is any company in which the 51% or more share is held by either central or state or jointly by both, then it is known as government company. Then it is known as what? Government company. Clear? Now, type of credit facilities. Now, if we talk about the type of credit facility, there are two type of credit facility: fund based credit facility and non-fund based credit facility. Fund based, where there is an actual flow of fund from borrower to lender. So bank borrower receives the money directly from the lender. There is flow of cash, like you are giving loan as a banker, you are giving loan. So this is a fund based facility. So should be a flow of cash, okay, flow of money from the lender to the borrower. Then it is known as fund based credit. Like if you have a cash credit, if you have a cash credit, overdraft, term loan, demand loan, and bill finance, these are all considered as what? These are all considered as the fund based facility. Clear? Okay, now there is a non-fund based facility. Non-fund based facility is the financial arrangement where there is no flow of cash from the lender to the borrower. Instead, they provide some assurance, or they provide some guarantee, right, to facilitate the business transaction. Then it is known as non-fund based facility. Now, if we talk about the non-fund based facility, examples are bank guarantee, letter of credit, acceptance facilities, etc. Clear? Now, last thing, let's talk about the term or demand loan. So, what is the demand or term loan? It is for meeting the expenditure needs of the business. Term loan is actually given in a lump sum payment, granted in one lump sum payment, and these are repaid over a period installments, right? These are classified into short term loan, medium term loan, long term loan. Short term loans are usually repaid within 1 year. Medium term loans are usually repaid between 1 year and up to 5 years, and these are long term, over and above 5 year. Clear? So these are the important things I have just discussed, the important thing related to these this chapter, right? Now let's talk about some of the question. The very first question is the share of public limited company are. Four options are given. Just please answer this question. The shares of a public limited company are non-transferable, transferable, sovereign, security, or negotiable. The shares of a public limited company. So if we talk about the shares of public limited companies, these are what? These are not freely. So these are actually transferable. They can easily transfer, right? Cash credit facility is a, if we talk about the cash credit facility, yes, it is a what? It is a fund-based facility, right? Now, all of the above working capital means. What is a working capital? So working capital is what? Yes, it is actually for fulfilling the day-to-day requirement of a business. So this is the complete chapter. I hope that you have all understood this chapter completely. So this is the JIB Super Elite all-in-one subscription in which you will get live classes, mock test notes, and everything if you are buying this subscription. These are all the batches in which you are getting the access. Okay, so if you are buying the JIP Super Elite all-in-one subscription, you will get the access of all these batches plus many more batches to come, right? So all the batches, all the things will be covered under the subscription. Okay, now there is a flat currently 49% off, flat 49% off on this JIP Super Elite all-in-one subscription. So if you are using this code FEST, so by using this code, you will get a flat 49% off on JIP Super Elite all-in-one subscription. Okay, so I hope that you have all understood this chapter. Kindly please like and share the video to the maximum you can. If you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Thank you so much. Take care, everyone. Bye bye, guys. Bye, everyone. Take care. Bye, everyone. Bye, guys. Take care.